Welcome to this market and economic update. Over the next few minutes, we'll discuss the economic conditions that have paved the way for the Fed rate cuts and why it's important for investors to maintain a long-term perspective with regard to the rate cut cycle. These rate cuts are a reversal of the rapid rate hikes the Fed made beginning in 2022 as it responded to inflation. Now, with inflation gradually improving and the job market beginning to slow, the Fed needs to maintain economic balance by reducing interest rates. First, this chart shows the past Fed rate cut cycles, with each cycle normalized to zero at the beginning of the period to make it easier to compare. The lines are annotated with the year of the first rate cut. As you can see, the Fed has cut rates many times over the past 50 years for a variety of reasons. Throughout history, the Fed has often been forced to cut rates to bolster the economy during financial crises and recessions. By cutting rates, the Fed can help stimulate the economy by lowering borrowing costs and boosting spending. The current economic situation differs from past emergency rate cut scenarios. Today, economic growth is steady, inflation is improving, and the job market is weakening slowly. This is quite different from the 2008 financial crisis or the early 2000s dot-com bust. Instead, today's situation is more similar to the rate cycle that occurred in the mid-1990s when the Fed raised rates to fight inflation before lowering rates again. This is often seen as an example of a soft landing, since the Fed was able to stave off inflation without causing a recession. Thus, the motivation for rate cuts matters quite a bit when trying to understand how it might impact the economy. Next, this chart tracks the unemployment rate as well as the underemployment rate. Both of these measures show that unemployment has ticked up in recent months, though it is still fairly strong by historical standards. The Fed's dual mandate aims to balance maximum employment with price stability, which it defines as an inflation rate of 2%. With recent improvement in inflation data, especially compared with the high rates during the pandemic, the Fed is shifting its attention to the weakening labor market. Since monetary policy tends to work with lags, the Fed needs to act before inflation falls back to 2%. If it keeps monetary policy too tight, it risks slowing the job market too much, which would have negative consequences for households and businesses. Finally, this chart shows the Treasury yield curve at 3 points in time: the latest market day, the end of the previous quarter, and the end of the previous year. Historically, lower rates have benefited stocks and bonds, with bond prices rebounding and stock valuations potentially becoming more attractive. Bond yields have responded to expected rate cuts through 2024 and 2025, with the yield curve disinverting for the first time since the start of the rate hike cycle in 2022. In anticipation of the cuts, short-term interest rates have begun falling, while long-term rates have not declined as much, resulting in an upward sloping yield curve. This is typically seen as a positive sign for the economy. As the Fed enters its new phase of monetary policy, it faces the challenge of supporting the economy without reigniting inflation. Over the next few months and years, the overall trajectory of Fed rate cuts will matter much more than the specific timing and rate of reduction, so it's important for investors to not overreact to any individual move. We've only scratched the surface on this important and timely topic. If you would like to discuss this in more detail, please don't hesitate to reach out. We look forward to speaking with you.